Welcome back to Trader UK. Today I'm going to be showing you how to read financial statements. I'm going to share with you on screen the financial statements of a very well-known company, and we will run through together line by line so that when your favourite company release their next earnings report or annual report, you'll have a much better understanding of what's going on. If you do learn something today or you manage to take a little bit of value from the video, do me a favour, smash the like button, and of course you can subscribe to the channel for more similar content. Now, the company I've chosen to use as our example is Walmart, and we're going to be using their quarterly report to the end of October 2020. It's worth noting that financial statements can cover any length of time. They could be a week, a month, a year. For investors in public companies, we're most likely to come across the quarterly statements covering a 3-month period, and then the annual statements, which obviously cover a year. This is because it's a requirement for US listed companies anyway to file quarterly and annually. It might be different elsewhere in the world, but most companies tend to follow that format anyway. And I've chosen Walmart because they have, if you think about it, a pretty traditional retail model, bricks and mortar retail model. So the financial statement should be pretty typical of what you can expect to see. It will be slightly different for every company, but there are accounting standards that mean the template is always going to be the same. So if you can get your head around this, you can get your head around any company's financial statements. Firstly, there are going to be 3 main reports that make up the financial statements. The page that I'm on now, this is the income statement, which is a backwards looking statement. So in this case, we're looking backwards at how the company performed in the past for the 3 months ended the 31st of October. The next page is in the balance sheet, which is a snapshot of where the company is as at the 31st of October, what we have, what we owe, assets and liabilities. And the third page is the statement of cash flows, which reconciles the profit that the company made with how much cash they actually have, because profit does not equal cash, and we'll come on to that in a little bit. This is a quarterly report which tends to be shorter than the annual report. Sometimes annual reports are 100 pages long. Even this one though, 13 pages long. So obviously we've got a bit more in here. On top of the 3 reports, you're also going to have lots and lots of commentary, which you should read through as well because it's for the investors after all. But it's going to be statements from the company and its board. It's going to be legal bits and pieces. And then there's going to be lots of narrative to the numbers. So if you want a bit further breakdown of revenue, you'll be able to find that in the supplementary pages. But we're just going to concentrate on these 3 main pages. So first of all, let's work through the income statement or statement of income or profit and loss, as you might hear it called. The 3 months ended the 31st of October is the period being reported on, and the period being reported on will always show on the far left-hand side under the 2020 column that I've highlighted in green, but the number on its own is useless. Numbers in isolation are no good. If I told you, somebody that's never considered Walmart as an investment opportunity, their revenue was 100 billion. You don't know if that's good or bad without knowing what they've done previously. And that's why they give you the comparative figures highlighted in yellow as 2019, and then a percentage change highlighted in pink there. And then they also give you the results for the past 9 months, which is their financial year to date. So the last set of annual accounts for Walmart were up to the 31st of January 2020. So they're just showing you how they've performed since then, again with comparative figures and a percentage change. It's also very important to note what multiple is being used here. If not, you might read the net sales as 133,752, which doesn't sound like much when it's one of the world's largest retailers. So in this case, it's in millions, which I've highlighted, but sometimes it's going to be hundreds of thousands, depending on the size of the company. And if you struggle to put that number into context because it's huge, it looks like 133,000 million, start from the other end and use your multiple. So that would be 2 million, that would be 52 million, 752 million, 3,752 million, 33,752 million, and then 133,752 million. It's a little bit easier to work that way to put the number into context. Now, the top rows on the income statement will always relate to revenue. That's why you'll hear analysts and investors saying, we expect the top line to grow by 5%. They're talking about the company's revenue. Increasing the top line or beating on the top line, that refers to increasing revenue or reporting more revenue than the analysts were expecting. Then you'll see that the revenue has actually been split into two different lines. You've got net sales and then you've got membership and other income. A lot of people always wonder why they do this, as surely it would be easier to read if they just put one line and added the two figures together. But what you'll find is that net sales, the figure relates to the bulk of the group's core activities. In the case of Walmart, we know their core activity. It's selling groceries and other products in their stores and online. But Walmart also owns Sam's Club, which is most likely where this membership income comes from. So Walmart probably take the view that we're not really in the membership business, and that doesn't make up part of our core activity, which is the retailer groceries. So for transparency, to make it easier for investors, they separate it out onto a separate line. Then you can add the two together to get your total revenue figure. That figure is often used to put a company's market cap or valuation into perspective. In particular, if you've got a company that isn't profitable yet or a high growth company, you need to take the annual revenue figure, not this one because it's a quarterly result, so annual report first of all, or maybe a projected annual revenue figure, and say, how many times do I have to multiply the revenue by to get to the market cap? That's why you'll hear investors saying it's trading at 50 times the 2020 revenue figure, for example. Cost and expenses, again, split into two: cost of sales and then operating, selling, general and admin. Again, there is a reason for this. Your cost of sales will include any expenses that can be directly attributed or apportioned to getting the product from A to B and then getting it sold. But they need to be directly attributed. So, for example, the cost of transporting the goods from the supplier to the warehouse to the store, that's going to be a cost of sale. The wages of the employees who fill the shelves in the store, that's a cost of sale. Wages of the checkout staff, cost of sale. The heat and light for the stores, cost of sale as well. Then you've got the operating costs, which will be expenses that can't be directly attributed to getting the product from A to B and getting it sold. So a good example are the salaries of the HR department and the payroll department, those kind of people. It's fundamental for the business. Those costs are fundamental costs, but doesn't have anything to do with getting the product ready, getting it from A to B and getting it sold. So those types of expenses are separated out. Now, it is important to identify cost of sales on a separate line because this is the figure that you use to calculate gross profit. Your total revenue above less the cost of sales will give you gross profit. In our case, it would be about 34 billion. If you then divide 34 billion by 134 billion, the revenue figure, and you display it as a percentage, then that's going to give you the gross profit margin, which in Walmart's case is about 25%. That's another important metric used by investors, because if a company is able to increase that margin, then that's a sign that they are either demanding a higher price for their products or they are cutting the costs in that chain. They're cutting the cost of sales. Either way, the higher the percentage, the better from an investor's point of view. Once you've deducted out the operating expenses, you're left with operating income highlighted here, which is a good sign of the overall success of the company, particularly for established companies. Following this, we're just deducting out the cost of financing our business, basically what it cost us to borrow the money that funded those results that are above. Now, with debt, it's important here that you understand which page of the financial statements you're looking at sometimes, because we're on the income statement, we're only looking at income and expenses covering the 3 months to October the 31st. Don't read this as a debt balance. The amount of debt that Walmart actually has is going to be displayed somewhere else. This is just the cost of that debt, so the interest payments that they've made. Finance lease obligations. Now, there used to be some pretty complex rules around finance leases and operating leases and the differences between them. It's been somewhat simplified now since I used to look at this, but a finance lease, this refers to assets that are being purchased over time. So usually for machinery or equipment, and this here, this is the interest element of those payments. They will be paying a lot more than this in their monthly payments, but remember, they're actually purchasing the asset over time. So some of that cost is going towards the purchase of the asset, which doesn't show here. We're just looking at the financing cost. Interest income. On this occasion, this is income from cash that they have in the bank most likely or deposited somewhere. So even though it's shown down here where you expect to see expenses, this is a source of income. But again, it's important that they separate it out because it doesn't make up part of their trade. It's just a byproduct of having that big cash balance. So if Walmart had a bank or a lending department, which they actually might do, I'm not too sure, then they make loans out to customers, and the interest from those loans would usually appear further up in the revenue section because that would be part of their trade. But in this case, it needs to be shown under the interest section as a cost of financing. So your net interest, that's your total cost of financing for the 3 months. What was the cost of borrowing to Walmart to fund those operations above? We also have other gains down here. Now, you have another source of income shown all the way down here. On this occasion, it is a gain, but you might also see losses down here as well. In the period, Walmart probably disposed of some assets or part of a business. I think it was probably Asda, actually, their UK operations. And that was around this time. So because the sale of assets is a one-off event, it's important that investors can see it highlighted in the accounts. If they included this 1.8 billion up in the revenue figure, then investors will probably be expecting that 1.8 billion of revenue next year as well, which obviously can't happen because they've already got rid of the assets. So important that it's separated out onto a separate line. The income before income taxes is just our profit figure, but before we take into account the tax implications. And a provision for income tax. Provision just means that it hasn't actually been paid yet at the 31st of October, but it's an expense that relates to that period. Now, lots of people will question the number here. I'm not too sure about tax in the US, but I think corporate tax rate in the US is 21%. But if you work it out, they've provided for about 27% there. The reason for this is because companies don't actually get taxed on this profit figure that shows here on the financial statements. There are a number of adjustments that has to be made to that figure before they calculate the tax. Some expenses in the accounts are disallowed and deducted, and then other reliefs are added back instead. So that's why it rarely adds up. Consolidated net income is just the result after we've applied the tax. And then this line is showing that included in the results above is some profit from a company that Walmart own less than 50% of. Less than a 50% stake is a non-controlling interest, and therefore they're saying that we're not really in control of what happens to that money. Just like you and I might have a non-controlling interest in Walmart with our shares, and we can't decide if Walmart pay a dividend or keep the money in the company. It's the same for Walmart. They have a non-controlling interest in another company. Consolidated net income attributable to Walmart. This is your bottom line or your earnings figure. Again, investors and analysts will always refer to growing the bottom line or an earnings beat. This is the figure that they're referring to. At the very bottom of the income statement, you'll then find details of how many shareholders there are, how the earnings look per share, and details of any earnings that are being distributed to the shareholders via dividends. It's best to look at the weighted average common shares outstanding. The basic line refers to how many shares are outstanding at the end of the period, 2.83 billion. And then the diluted line, normally this refers to some kind of debt instrument. Walmart probably have a loan from someone, and in the conditions of that loan, whoever made the loan will have the option to convert that debt into new shares in the company, which has a diluting effect. That's normally what it refers to. So they're just saying If they did exercise this option, then we would actually have this many shares issued. And then all they've done above, this is your earnings per share figure, or EPS. So all they're doing is dividing the net income by the basic shares outstanding or the diluted shares outstanding. You can do that calculation and you'll see that it comes to 181 or 180 for the diluted. Again, this can be used as a way of justifying the valuation of a company as well. You would want the annual earnings figure, not the quarterly, but you would just take the current share price and divide it by annual earnings per share, which will give you a PE ratio or price earnings ratio. If you want to calculate the forward PE, then you just replace the earnings per share figure with a projected earnings per share for a future period. It's all pretty simple, providing you understand that whenever they refer to earnings, they're talking about the bottom line, not the top line. And then we've got a line at the bottom for dividends. You can see here Walmart didn't declare any dividends in this quarter, which I'm not so sure about. I think they always pay a dividend, 55 cents, something like that. It could be because they declare that dividend at the start of the year. It wasn't actually declared here. But I think if you look, they did actually pay one in the end. So I have actually mentioned before on the channel that a company pays dividends from profits. So if a company has only ever made a loss, then it cannot pay you a dividend. Even if it has plenty of cash in the bank, you can, though, retain profits within the company like Walmart are doing here and then distribute them at a later date. Now let's move on to the balance sheet. This is a snapshot of the value of assets and liabilities as at the 31st of October with some comparative dates again. It is called a balance sheet, by the way, because it balances, not because it lists out all the balances of assets and liabilities, because it actually balances. There are always three sections to the balance sheet. You have assets, liabilities, and equity. If you add together liabilities and equity, at the very bottom here you get 250 billion. Scroll to the top, that should equal 250 billion, the total of your assets. That's why it's called a balance sheet. So first up, we've got current assets. The first assets listed will always be current assets, which are assets that can be converted to cash within 12 months. Anything that takes longer than that, longer than 12 months to convert into cash, that will be listed further down as a non-current asset. The current assets will always be listed in terms of liquidity, so cash and cash equivalents. A cash equivalent is something that can be converted to cash immediately. That's your most liquid. It's going to be right at the top there. Then you've got receivables. They're customers who have taken goods, but they haven't paid you yet. They owe you the money. So that's the next most liquid because a sale has already been made. We're just actually waiting for the payment. Then we've got inventories or stock. That's your third most liquid. You need to make the sale, then sometimes you need to wait for the payment before it's converted to cash. And then finally, you've got prepaid expenses and other. Prepaid expenses are expenses that have been paid for before the end of October, but they relate to a future period. So they sit here as an asset and then they move into the income statement above, probably in the next period as an expense. So our total current assets, 73 billion, and they are assets we're expecting to convert to cash in the next 12 months. During the pandemic, it's been really important to keep an eye on this cash balance and to some extent the other current assets as well to help gauge a company's chances of survival. In times when they often can't generate any significant income, they're reliant on their cash reserves here. So always a good idea to keep an eye on this. Then we've got your longer term assets that won't be converted to cash in the next 12 months. Property and equipment. When Walmart buy a piece of equipment or property, they usually have to decide on a depreciation policy that spreads the cost of the asset across its useful life. And then every now and again, they have to do an assessment to make sure that the value shown in the accounts is correct. But as you can imagine, there's a lot of potential for error here. If, for example, they were valuing equipment and property 20% too high, then they would need to adjust for $20 billion, which is done by putting a 20 billion expense on the income statement. So it's very important the fair value of the asset is reviewed on a regular basis. Operating leases and finance leases, the rules have changed on this. It used to get really complicated actually, determining between the two. They've tried to simplify it a little bit. Both of them relate to leasing equipment or property maybe, but they're shown separately in the accounts and they're treated slightly differently. If Walmart leased property, for example, but they're never actually going to own that property, they're never taking full responsibility for it, then the asset is probably going to be an operating lease, and that's where it will get listed. And to account for it, they list the current value of future lease payments here as an asset, and they list it a bit further down as a liability as well. For a finance lease, maybe if they lease some equipment that transfers ownership to Walmart at the end of the lease, then technically that's, even though they haven't paid for it all yet and they haven't transferred ownership, technically it's still their asset. They have right of use of it and full access. So they would actually record that as a finance lease, and instead they would record the value of the asset, not the value of the lease payments, the actual value of the asset. So they're treated slightly differently here. Goodwill is actually usually shown on the balance sheet where maybe Walmart have bought another business. Say they bought a business for 100 billion, they would have all of its assets added up and valued, and let's say it came to 70 billion. Well, the difference of 30 billion, that's the goodwill. That's what they're paying for the non-tangibles like the reputation and the brand recognition. So that's normally why you'll see goodwill on the balance sheet. This one could be some type of longer term investment. You need to read the full notes to the accounts to get more detail, but because of its positioning here, what we know is that they're not expecting to convert this to cash anytime within the next 12 months. So we got total assets here, just over $250 billion. Then we can move on to the liabilities section of the balance sheet. So these are amounts that are owed. The same rules apply. Anything falling due within 12 months will be listed first as a current liability. So we've got some loans that need to be paid. Accounts payable, these are suppliers that we've probably received goods from, but we have credit terms with them, so they need to pay them at some point. Sometimes it's referred to as creditors. Dividends payable, like I said, they tend to pay a quarterly dividend, so this is a balance of dividends that haven't been paid yet. Accrued liabilities and accrued taxes. The idea of accruing liabilities is just recognizing expenses that relate to the period but haven't been paid yet and we haven't received an invoice for them. So if you don't create an entry in the accounts, then they just wouldn't get recognized until the next quarter when they're actually paid. So that's what they're doing here. So they have some long-term loans as well, but part of that loan is due to be repaid within the next 12 months. So they have to split it out. You can actually see long-term debt due within 1 year here. That's the amount that has to be paid within the next 12 months. And then the amount that will still be owing after that 12-month period is shown further down as a non-current liability under the long-term debt line. Operating leases and finance leases, we've mentioned, we won't go into great detail on them, but again, you can see they've split it out between the payments that need to be made within 12 months and the longer term payments below that. Deferred income taxes. Now, you're probably getting sick of income taxes. It was mentioned once on the income statement. It was mentioned once on the current assets above. So why are we seeing it again? Well, this one is a little bit more complex to get your head around, but remember, on the income statement, when we said that the tax charge doesn't equal a straight 21%, and it was down to the fact that the net income per the accounts is often different from the actual taxable income, as the tax office let you recognize some income or some expenses that the accounting standards don't, and vice versa. So the deferred income tax liability here is a way of recognizing that. It's Walmart saying, we've already recognized more income in our accounts than the tax office has actually taxed us on. So technically, we owe tax on that money as well. Even if we haven't been asked for it yet, we will owe it at some point. So they recognize it in the accounts here as 13,600 million. Now the equity section, or capital you might hear it referred to. We already know that Walmart have 2.83 billion shares outstanding. It showed us that on the income statement, and they have a value here on the balance sheet of 283 million. That means that when these shares were issued or created, they had a value of 10 cents per share. That's called their par value. But when shareholders purchased the shares from Walmart, they didn't pay 10 cents per share. They paid more than that. So the excess of the par value is shown here. Once a profit has been made in previous periods, the company can either pay it out to shareholders in a dividend, or they could hold on to it, they could reinvest it, or maybe hold on to it and pay it out to shareholders at a later date. According to this, Walmart have 92 billion that they can pay out as a dividend tomorrow if they wanted without a problem. Of course, that never usually happens, but when you're considering Walmart as a stock, I don't know what the current share price is, but within that share price, there is, $32, I think it works out at, per share of retained earnings that could be paid out as a dividend at any point. Accumulated other comprehensive loss. So this would usually mean that one of their investments that they made has gone bad or fallen in value, but they haven't actually sold it yet. So it's more like a warning of losses that will be realized at some point in the future. So that's the total equity relating to Walmart. We've also got some equity relating to a company that Walmart have less than a 50% stake in. Remember, these are consolidated accounts. Walmart is the parent company in a group, so some of the results and the balances are from investments. There are specific rules as to how much of their results are included, depending on whether Walmart own more than 50% or less than 50% of those companies. Again, we won't go into great detail on it today, but they're separating it out here to show the equity from the non-controlling interest. And again, you can see here that the total liabilities and equity, 250 billion, is equal to or balances to the total assets, 250 billion. Now we're on to the statement of cash flows. I'm not going to run through this line by line because I'm going to be repeating lots of what I've already said, but an overview of what's happening. They're taking the profit figure for the 9 months ended the 31st of October, so the accounting year to date, 15714. You can see it there at the top, and if you go back to the income statement, you'll be able to take that figure directly from the income statement, and then they're just adjusting it by removing any accounting entries like depreciation or gains and losses. So you have to remember, depreciation isn't an expense. The expense, like a cash movement, is buying the asset. But nothing leaves your bank when you depreciate an asset. Same with a gain or a loss. The gain or a loss is not a cash movement. The proceeds from selling an asset, that's a cash movement. So they're adjusting for those accounting entries here. So you can see they're making adjustments for the operating activities. They do the same thing for investing activities and the same for financing activities. That's all that's going on here. It's not actually as complicated as it might look. And the summary at the bottom here tells us we've increased cash and cash equivalents by 4.8 billion in green. We had 9.5 billion at the start of the period, and we're moving into the next period at the end. We got 14.3 billion by the end of the period, highlighted in red. So at the very bottom, we got cash, cash equivalents, and restricted cash at the end of the period. 14,378. If you want to see how this ties up, then you can head back up to the balance sheet. The top line of the balance sheet will be the cash and cash equivalents, which is 14,325. So there's a small difference there, and that's probably because, well, this line is cash and cash equivalents, whereas our other line at the bottom was cash, cash equivalents, and restricted cash. So a tiny difference, but you can see how it all ties up. And this is really important to consider because it's not actually being non-profitable that kills a business. It's not generating a positive cash flow. You could have the most profitable company in the world. If they don't have a positive cash flow, then they're going to have issues. For example, if you start a business by purchasing goods for resale and your suppliers offer you 30-day terms, but when you resell the goods, you sell them on 90-day terms to your customers, and you're going to have money going out quicker than it's coming in, and it creates a cash flow problem. Even if you're selling them at a profit and making a lot of money, you're going to have issues there. So this is always worth a quick glance at when you're reviewing a company. That is everything for today, guys. I hope you found it useful. Don't forget to like and subscribe. Thank you for watching, and I'll see you next time.